This week in life insurance, we're still coming to you from Mexico. Keeping up with the tradition, we are coming from one of our favorite coffee shops here. This is Gilly in the Condesa neighborhood. We're pretty much been coming here every day. It's great. And speaking of Mexico, we actually met up with some new friends in the industry this week, and we had a really interesting conversation about private equity and the way it's coming into the industry and whether its incentives are aligned with kind of traditional insurance players and clients. So earlier this week, you might have seen that a producer had a majority stake sold to a private equity company. And that's pretty unusual. We've seen private equity coming at the carrier level, at the distribution entity level, but not really at that individual producer level. And it raises questions of, private equity has timelines around 5 to 10 years and are really managing for cash and free cash flow, but that's not necessarily the best interest of a client who is entering into a life insurance contract that could last 40, 50 years till their death. So how are those two kind of differing incentives going to match up? And we also see it with private credit. The private credit boom is really being financed by life insurance premiums, or life insurance carriers are purchasing these private credit instruments because of their long time horizons and yields. But those private credit instruments might have higher risk profiles than life insurance companies usually go for. So how are these different incentives going to work out as well? I don't really know the answer. I don't know if this is good or bad, but it's something we should be paying attention to, and I'm not sure it's something we're talking enough about in the industry. That's all for this week. We'll talk to you soon.